Again, thank you for joining us. I know, again, it's late at night, but I really appreciate your dedication. So, I am actually in Las Vegas. I arrived last night. Uh, haven't seen the lights, so I don't know how many lights are going to be on tonight in Vegas. So we'll find out. So we are staying with our friends, dear friends here, and it's going to be a little discovery to see what is going on with this new environment and new economy, and in the city which never sleeps, and the city that really lives on leisure and traveling. So it would be a good experience. Today I thought we'll do a little differently, as I will share again a little bit of a history and look at the markets briefly. And what I thought we'll analyze one of the trades that I did last week and give you my reasons. And I thought that way might be helpful to understand what are my thoughts. And as I have mentioned before, it's almost like playing an instrument. It's like playing soccer or any other sports. Uh, just by practice and being there, things start making sense. And again, I've been doing this for so long. Sometimes I just subconsciously I know what's going on, but it's in the beginning, some of the things might not make sense, but hopefully through practice and maybe seeing from my point of view, it might make a little sense. Uh, the other thing I thought I'd do this week is rather than going through like the indicator of the things, I thought introduce like a strategy that you could apply today and start at least studying it to see maybe it could be a profitable way of using for your investment and hopefully making it profitable. And then at the end, I'm going to give you a list of some of my COVID watch list and some the Bitcoin shares that I spoke last week about Bitcoin. So I thought this time let's work on some publicly related Bitcoin shares that if you're interested, maybe you can invest in it. So history, I thought this was interesting about the virus cycles, that every 100 years we've had something from smallpox to measles to later pandemics to influenza, and the timing of it kind of caught my eyes. So sharing that, just these are trivias, but it's interesting. Um, this is a day we call the flash crash. It happened almost 10 years ago to date. It was on May 6th, actually on my anniversary, and it was one of my best days. It was a day that I was anticipating a drop in the market, but never thought a craziness like this happened. So the lesson I'm gonna work on is, even though if you know you're right and you know things are gonna happen, that doesn't mean you're really you will be very profitable. I mean, the day like this, when the market dropped close to 1,200 points, I had shorted the market here. I was thinking it's gonna go down, and I will let you read these things. And as it's going down, this is futures market, by the way, and every 1 point, this is on Dow, is $5. So you would think one contract had like five. Every contract drops 1,000. That's like $5,000 one contract. So I'm like, I'm saying, oh my God, what a great call I had, and it's going down. And as it's going down, I tried to cover. That means I want to buy it back, and I couldn't. I never forget that day. So although there was just the circuit breakers, there was a lot of institutions ahead of me. So as a retail investor, sometimes we have advantage because we don't move the markets, but sometimes we have disadvantage. Goldman Sachs of the world, they were front running me. So I couldn't get out, I think somewhere around here. So I missed a big part of the drop. So these are the lessons, the reason I say that. So you have to, you cannot have perfect timing. You could have the directions, and sometimes even that's why it's good to have some limits, even though some of them they just went through this. But this was a unbelievable day. I don't know, some of you are not old enough, and some of you maybe weren't in the market, but it was a crazy day. That was flash market, May 6th of 2010, and I thought it's appropriate exactly 10 years ago. Look at a little history here. And at the end of the day, look what happened. The market, after all that, was down 3.2%. Now, what is happening with our economy? And again, it's mind-boggling. It's like I mentioned, there's this connection last week about the markets, talked about Wall Street and then Main Street. We keep getting the news. We got the retail unemployment now claims up to 36 million. And what is happening? The worst, I mean, in the retail, we dropped 16.4%. And with all that, and then you look at David Tepper, hedge fund manager, Stanley Meyer, they all come and say, well, this is like the most expensive market they've seen. They don't think this is the end, but yet markets still, digesting. They're not dropping that much. And why is that? So simply, there's two things. I think one is, I've said it before, you cannot fight the Fed and its liquidity. That printing money, that as long as the liquidity comes in the markets, you will have, regardless of what companies they are, because there's that liquidity, they are being really saved in the short run at least. So, and we also, what is happening, there's a lot of sector rotation. So the money, one day it goes to tech, all doing good, and then sometimes you see the money moves away from them, and like last week we had a couple of days, and the financials, the money moved from financials to tech, then it's back to financials. Tech was going down on Friday, the energy. So there's, you can see these rotations. So on the surface, the stocks are going down or going up an average, but the markets are not really reacting as much because of, again, there's the liquidity and this rotation. Also, again, there's a two tails. What we will see just on the retail stores numbers. As you can see, the non-store retailers, companies like Amazon, well, they're up 8.4. They were up 8.4%. Building materials at garden equipments like Home Depots of the world or Lowe's, they were down only 3.5% because it looks like average. But then you go all the way down, the clothing and accessories and electronics and appliances, basically they got the big chunk of that drop. So there are the tail of two sorts. You cannot just say, well, retail was down, well, because people are not spending money. Well, there is a truth to that. And then we look at like a health and personal care, like some company like Johnson & Johnson has a big portion of it. Its sales comes to the consumption, the consumers. So they were down 15%. So this is what I want you to understand, that it is not, we cannot just generalize and say, well, this segment, things are down. Well, there are some strong points and there's that rotation. The other thing I have to tell you is, I mentioned last week, and I think we have to, again, think about it. This is not just, I went over the S&P 500, and I also spoke about the dollar, about the gold. We looked at the Dow Jones, the bonds. If you go back to March 23rd, the biggest move on majority, except technology, which is still in the uptrend, everything happened within 15 days. And look what we are now. This is the S&P 500. This is called range bound. So from before April 13th to now, almost 5 weeks now. Last week I was saying about 4 weeks. Now it's about 5 weeks. We call it range bound. So I put this, you can see in SPY, if you look at the ETF, it's like we are ranging between 275 and 295. Now, something is happening. As I mentioned, because when there's a sector rotation, this happens. But also you can see the bad news comes and the markets move. And I mentioned last time, there was a couple of reasons. And you can see the volume really last week we noticed the volume is low on the up days. So where is that money coming from? So as I mentioned, one was like the Fed. The other part is the retail investors. So it's not really the institutions. There's the algos, the computer program, but the retail investors are, as I mentioned, historically, last time in 2009, they thought they missed the boat. TD Ameritrade alone, I think first quarter, they had about 600,000 plus new accounts. I think total accounts were about 3 million open, and all of these were from retail. So we are having some, again, non-institutional investment going into the market. And obviously, we got the time off. There's the computer, the laptop is the trading. So, well, why not make the money now? Because we don't want to miss the boat as we did, again, 10 years ago. And as I mentioned, a lot of people, it was a psychological effect, because what happened was they thought they missed the boat, because a lot of people didn't get back to the market till probably 2011, 2012. So when the market's average, we talk about S&Ps up for the past 10 years, that doesn't mean average investor has made that much money. And I mentioned last time, average investors for the 20 years was up for maybe 1.9% compared to the markets. So now what does this mean? And I'll look at the New York Stock Exchange. You can see it's the same story. We are range bound. When something like this happens, it's almost like a coiling. So the energy is being saved inside this box, and eventually the steam is going to go somewhere. I mean, we are right in the middle of it right now. So I have a bias, but again, we don't. I had mentioned many weeks ago, I mean, you want to anticipate, participate, but you want to do the things that you see, not what you wish to see, or have your biases already. Oh, I know the market is gonna really go down. I can't wait. Or it's gonna go up. I know these technology companies. We're gonna go back. Apples and Amazons and Googles and Netflix are gonna take the whole market with them. Basically, right now, I know my biases, but again, I'm just watching. I'm being a trader rather than a long-term investor at this time. And I mentioned last week, being in cash is not a bad thing. There's a lot of opportunities could come our way, I feel, in the next 3 months. So right now, there's just a lot of energy. So what happens, the longer this goes, the more violent the breakout it will be. Now, this is a time you can use some option strategies to take advantage of it. But right now, you cannot really put all your eggs in one basket and say, well, I know something really bad is going to happen, something really good. But all I can tell you, you're not going to have you're not going to have this another gradual movement for the next 4 weeks if we break down or break up. If we break down, it's going to be violent. So I just want to, again, the whole purpose of our meetings on a weekly basis, to just give you tools and hopefully confidence that you understand the whys, and then you're not captive to, I have mentioned before, to CNBC or Bloomberg. You can make your own decisions. But and then visually, you can actually even see it yourself. So going back, for instance, you can see with S&P, this is a 200-day moving average. And today we're going to talk about moving averages, which is almost 3,000. Now, the raw numbers historically are very important resistance levels or support levels. Psychologically, things happen at, let's say, in a round number, in this case 3,000, and being on 200-day moving average, we got 61.8% Fibonacci. So this is a heavy resistance. The other thing about the resistance, these numbers that I see, it doesn't have to be, like, there's no magic saying, oh, once it's 29.98, it's gonna come down. These you have to approach as a zone. The way I can tell you when we talk about this as a ceiling is almost think about a herd, a cattle, and they are fenced in. And what happens, all these cattle, they push the fence, and they can push it a little farther, but eventually they push back. And that's what resistance is. So resistance is not a magical one number and a line. It's actually a zone. So it can move, can be pushed back, but that it's not going to break. It's going to be difficult to break. So, but we will watch this zone and see. And once it's broken and there's a confirmation, then there's enough energy to push it much higher. On the other hand, the downside is a lot easier to break. So it looks like the bias could be to the downside, but I'm not right now. It's still neutral. I just want to share that with you to see how to read that. I mentioned about Fed, and the Fed is buying these exchange traded bond funds in different vehicles. They're using BlackRock and PIMCO to do their bidding. But you can see this is again the Thursday when Fed announced they're gonna invest and buy the ETF, and basically the investment graded bonds, the high yield junk bonds, to save these companies. And you can see we've come back to the support that the moving averages, and we bounced back. So the Fed is not going to let, as much as they're going to try to keep this fund up around here, they're not going to let it break down as long as they can. In the past, I've also shared that this is the average. What percentage of S&P 500 stocks are above and or below their 200-day moving average? Because 200-day, you will see, is an important criteria, especially for institutional investors. Now, the markets really were oversold. If you recall, we went to almost 1. So that was a good indication that we are so far away that we are ready to bounce. But now, again, look at this. Last 5 weeks, they're just floating around 18 to 30% of the stocks. That means 70% of stocks are under their 200-day moving average. And that's unhealthy. That means the broad market is not really moving in strength. So that's why I like to see this. These are, again, this is through the stock charts. These are all free sites, so you can have access to it. And, once a week, just review this. This is for your own, again, information, but also gives you some clarity. The other thing I've mentioned before, I look at the Baltic Dry Index, and that's the shipping rate for the dry goods. So right off the bat, you can see what happened. I mean, one of the reasons there was a China trade and other things. But in December, you could see we were over 1,500. And this is not an index. You cannot trade this. This is just the pure numbers. So you can see what the rates that shipping companies were charging for the cargo. And then you can see in February 10th, we've been going down. So it's usually a leading indicator. So what is happening again on April 20th, we peaked at 750. And again, we are going down to 400, which is very low. So you can also look at weekly compared to the last 3 years where it's been. Again, these are the tools for the economic activity, what's going on. So that's basically analysis of the week, in the sense that I just want to give you a little heads up what's going on. Again, there's something coiling, something is cooking. I don't know what's going to happen next 2 weeks. Friday, some people say, well, Friday was really a weird day, a strange day, because, like Apple dropped, technology was down and financials went up, and then there was this movement. You have to also remember, it was an option expiration. So funny things happen. There's a lot of filling. You gotta, obviously, the companies, there's roles they have to cover. So in option expiration week, which you get it every month, the major ones, funny things happen. So we'll see what happened Monday. You have then we have Memorial Weekend coming. So we are really interesting times, and that's what I mentioned. And I'm hoping we'll continue this. This has become really a trading environment, and a lot of traders they're having a ball because trading is based on volatility. But with trading, as I mentioned, it's your psychology. You have to be a master of your own. You have to understand who you are. Until you master that psychology, and I mentioned last time the biology, it could be a dangerous game. You have to know where your fears are and master that. Your greed, which greed is really nothing. It comes from even fear. Are you fear that you're missing out something, or you have these biases? Sometimes you're overconfident. So basically, you have to really find out who you are to become a really good trader. It's almost like a poker player, really. So this is what I did last week. So this was a futures, which was the S&P 500 futures. This is Monday afternoon. It was around 12:30, and I decided to short the market at that time. Bought the contracts, and I covered, and the last one was covered here. So this was a really short-term trade. So about half an hour. It was a nice move. Obviously, I missed this boat. So make sure, that's another thing I will say, if you're trading, you don't have to sit there for 12 hours or 8 hours in front just staring. Know your times. I've mentioned Mondays are not really the best days to trade. Obviously, I did it here, and I tell you why. And that was the reason. But usually the meat of your trading comes from Tuesday, Wednesday, Thursday. But when you are trading, don't equate it that you're getting paid hourly. Nobody pays you for 8 hours of staring at the computer. You want to be patient. After 8:30 in the morning Pacific time in California, for instance, about 9 o'clock to 11, nothing's really happening. I mean, even though a lot of people are here at home, but majority of times, lunch hour, usually New York, and we will talk about the volume. Basically, just know, meat of your activity comes like maybe at between 7 and 8:30, and then after 11, I wouldn't even trade after 12:30, saying, in my case, because I had this, just visually, I saw something, I had the gut feeling, but I had reasons for it. That's what I want to share that with you. But something happened here, which I had to leave. There was some external, exogenous force, and I will show you sometimes outside our control, and that's the dangers of working from home or when you have family or some things can interfere. So that's why I like to, as a day trader, I like to cover my whatever I have opening, so I don't have to worry about overnight. So as you can see, I could have made, each contract is like 10 more points, and each contract is like $50 for S&P. Would have been a nice trade, but that's okay. I did good. But why did I short this at almost 12:30 on Monday afternoon? I've been looking at the charts. This is from Finviz. Again, you have access to these. So I noticed from beginning of May, about May 4th, I looked at some of the moves that were happening. They were overnight. So they were coming from either overseas or something was happening. And this is the volume. You could see the volume is nothing. And that's why how you can, with a very low volume, you can move this drastic. It's like, again, supply and demand, right? So even a little demand pushes the prices up. I looked at May 5th and I noticed again, there was a movement. On May 6th, you could see we had a big chunk, even though during the day, you can see this volume. This is we're opening in New York, and obviously I'm in California. The market dropped. When you read, it's like, oh, the market was up. Well, everything happened from after hours, we call. So before the New York Stock Exchange opened at 6:30 Pacific time or 9:30 their time, New York time. May 7th, look at this movement. Huge. And then during the day, not much. May 8th, same thing. So I don't want to say it's like could be Fed. I mean, who knows? I mean, someone was moving these markets with small amount of energy, which is great, right? They don't have to invest too much. little volume to move these. So the same thing happened, and here I'm like, something is not. This is May 11th. This is when the whole thing started happening. So that gave me a warning sign, and I said, this cannot go on. I just want to know what is, with all the news coming out. And so I was prepared, but I needed confirmation. The second thing I looked at is, we've talked about Fibonacci numbers, and the Fibonacci numbers, as you know, is basically, I don't want to go to the history of the 12th century and the mathematician, but it says that nature works, the universe has a pattern. And that's what this whole world, I mean, you look at, there was an intelligent being behind all this. And because of that, we have patterns that we abide by it. The leaves, the lines, if you look at the leaves, they are all organized. We look at the planets, we look at the stars, everything has a discipline, and it has a real reason for being. So this is, it shows that, this is from the high of SPX or S&P 500, from the top in February around, I think, 20th, 27th, I think, to drop of the March 23rd. The markets like to retrace to their 50% and then 61. So as you can see, on May 11th, we had hit that 61 once, and then we hit it again on May 11th, that area. On top of that, on Fibonacci, there's few ways, and I'm hoping I will do some videos to show you it's not just one thing with Fibonacci. There's different ways you can do this, Fibonacci extensions. There's also called, this is Fibonacci price retracement. So usually the price in any stocks, it could be in Forex, they use a lot in currency in Forex. This is big. A lot of institutional traders and obviously big commercial, they look at the Fibonacci retracement. But on top of that, there's a Fibonacci, not price, but time. So you have to like really flip this over and see from the time point of view, from the top to the bottom, it gives you the retracement from the time point of view. So usually when we hit that time, the big movements happen. So either up or down. And this is May 12th. This line dictates May 12th. And May 11th happened. So I'm looking at, there's that 61.8. May 12th is my time. Could be short term, but it is my retracement. Now, why 12:30? This is a 60-minute chart. And as a trader, you want to look at 5 minutes, 60 minutes. I look at 240 minutes and daily. So I could see on a daily, we are up under resistance. This is my linear regression line. And as I said, I like mathematics and I enjoy, because I don't want to just guess. I don't want to, fundamentals are very important. I study it, but the fundamentals to give you that the whole idea why you want to hold it for 10 years, why the company is where it is. Technicals, they give me that the short term, they don't go with the why, they just know where the price is and where, and the price is the fair value at that moment. At that moment, the investors think this is the fair value for this. So I could see this is one standard deviation, which that means in this case, when it's inside this one standard deviation, you have about 68% of time your price will be held. 2 standard deviation goes to about 95. So basically we hit that. So you can see these long tails, and we will talk about it in candlesticks. So there was, every time we went 60 minutes, there were sellers coming in. So that was another heads up for me. And then I looked at the 5 minute, the same thing. This time we hit the 2 standard deviation. So basically, I'm getting all these confirmations. On top of that, I looked at, these are Keltner channels, which we talked about. And this red one is, it is called Bollinger Bands. Again, these are standard deviations, and these are ATRs, or we talked about average true range. So I'm looking at all these. I'm making a story, like this is a scenario, like a Seinfeld, right? So I have all these characters in there. There's a theme. So every time you watch a movie, there is one central theme. And in this case, I noticed, well, this is the odds. So the probabilities are in my favor because we don't know what's going to happen next. All I want to do, I want to make sure the odds are in my favor. Look at the momentum. Momentum is below zero, so that means it's negative. So basically, that's what I was thinking, and that was the reason I went short. Now, with that in mind, I just covered it within half an hour, made okay money, and then I said, you know what? This is not a one-day pattern. As we talked about, May 12th, something could happen. I want to be prepared for that. And this is what a big, we learn from our mistakes. This is what I decided, which was my thought was right. Everything was good. This is at 12:31:59. I decided to buy 5 option contracts. And what options, as you know, we mentioned before, is a derivative. And I was betting that S&P, which is a spider now, it's like a spider, and this was going to expire. So I bought it, supposed to buy it on Monday, expiring on that Friday. The S&P was around 294, a little under that. So I bought right at the money. I said, let me buy put options, and putting means putting down. So that means it's going to go down, and that's how I make money. Call means calling up. So when you say, oh, I want to buy a call option on something, you're making a bet that's going to go up. So those are the differentiation. So I said, excellent. I think I'm pretty convinced. It's pretty conservative, 5 options. The price at that time was 332 bid and 334 ask. What that means is, I mentioned before, we want to do all the limits, but if I would have just say market, I just want to buy this, I would have bought this at 334. Well, my computer, with my trading platform, I always do limits. So automatically, what the computer does, it puts the middle limit. So it says, oh, Rami, we're going to save 1 penny if we go to 333. If I would have bought at 334, I would have been filled. I would have had 5 contracts of this option. What happened was, at that moment, the stocks, or the spiders and S&P started dropping. So I never got filled. Again, remember, this is $1 per contract. So I kind of saved $5 not being in it by having 333. Well, I didn't, and it expired. So I never hold that option. Let's fast forward. So remember, this was $3.33. This is 3 days later. So I was buying it right here. That option went to $17.06. So basically, I was saving $1 and I lost. This is per contract. You were up over almost $14 for one contract, which is about $1,400. So just by not paying attention, I should have just said, I'm convinced. And those are the times it's okay to buy market. And the reason you want to do limit, obviously, is a discipline, but it's very liquid holdings like spiders or QQQ, or even the futures, because they're so liquid, the spread is very low. So really, it's like 1 cent. So you cannot really be so choosy. So this was a good lesson, and I would have probably made average of this was up about 440%, which could have been. So this is a could have been, would have been, but it didn't. So that was a lesson. This was a expensive lesson in a sense, but it's good to know. So I will not repeat that. But again, there was exogenous. There were some other things that are happening at the household. So I kind of wasn't bothered with it. But this is what I wanted to, why actually I wanted to buy puts on on S&P, and I didn't have to wait till Friday, so you will cover. I also had bought the week before, on SDS, which is the inverse or opposite of SPY. So SDS goes up when the markets go down. So I had done put selling. I don't want to go to, and my timing was pretty good, but as you can see, I always scale out. So, and I got out, so I sold these at 120. That means I collected premium, almost like an insurance company. They paid me to insure them. And then I said, okay, that's okay. No, I don't want to insure you anymore. So I paid them back 20 cents. So I got paid 120 and I paid them back about 60, 35, and 20. So it wasn't a bad, like a rental property or insurance company collected the money. All right. So I thought to share to you that all of us, whether you're around business investing 35 years or a year or 6 months, we all have to learn from our mistakes, whether it was a mistake or not, but that was a lesson. We always learn lessons from anything. And that's what this overconfidence can become very dangerous. As for new traders, I'd rather them to lose the first 2 or 3 trades than win big. And that's what happened in 1990s. In 1998, 1999, 2000, everybody that I knew, we go to the parties, they just bragging about how much money, how genius they are, how much money they've made, how genius they are. And in 2001, none of them were the genius anymore. They still have capital losses from those days. So you want to be humble, you want to have the humility, you want to learn lessons. Keep a journal. I take pictures, as you can see. I make notes, and I want to see why this happened, and what was my as far as state of mind at that time. Was that in this case, as I said, there was exogenous things happening. I remember in 2008, I was that was the largest number of, it was election time, and I traded 1,200 times, close to that. I paid $5,000 in commission because my mind wasn't, I was over trading. There was some, again, outside things. And those are the times you do 3 trades and you have to know your limit. I wasn't, and that was expensive lesson. Although I made good money and my trades were profitable, but when you pay $5,000 in commissions, you're exhausted, number one. And then I didn't make a lot of money. It was not a good day, but I learned my lesson to be patient, to know, again, who I am, what is my best as far as trading strategies, and again, learn and just keep learning. So today I'd like to talk about strategy, but before I do that, I'd like to review again, the strategy is around moving averages. And with the moving averages, basically, what is it? It applies, it's like one of the simplest things, but a lot of people use it. And why we even talk about moving averages? Because it really doesn't mean anything, because you can create anything. Moving averages is just a smoothing criteria. When you go to school, and basically, again, the moving averages, you add 3, 5, 10 different things. Then when you average it out, at least you have a criteria to compare with. So when we go to school, let's say your grades are 90, 92, 94, a pure average, that means if you got these grades, on the report card comes, you got 92. So rather than telling the parents, for instance, let's say in my children's case, then I know, oh, your child had grades of like 10 grades, and now I have to say, well, where is he standing or where is she standing? They say, well, he or she averaged 92, so now I have a better understanding. So that's what averaging means. So it just gives you a clearer picture. There is no magic numbers about these, anything you can choose. It just want to have visually something to have used as a criteria. Now, moving average, what do we see moving? Because what happened is a moving target. So let's say you want to use a 3 moving average. It could be 3 day, 3 minute, 3 month. whatever it is, you just want to take average of the most recent 3. So let's say in this case, my daughter got 90, 92, 94, but her 4th grade was 96. And teacher said, well, you know what? We're going to take your last 3 grades. So they drop off the first one and they average it, these 3. So apparently, because she's been studying hard the first time, she had maybe sleepless, didn't do a good job at the test. Now her grade goes up to 94. And now what happened, we went from 92 to 94. So the slope is up. So we are now moving up. And that's how the moving averages are used in stock or any type of investing, to just give you that visual. Again, I am pretty visual, so it gives me the idea to see, all right, when these are like these law and this price goes up, down, well, in last 10 days, in last 20 days, last 30 days, what has happened to that? So it can give me a better indication. And then because it's average, it tells me, if it's under that moving average, that means recently people are not too enthusiastic about this holding. So that's what maybe they're selling. And let's move on, because what happens, you will hear a lot about something called simple moving averages versus exponential or weighted moving average. Most of the time, just for simplicity, I just want to tell you, we use simple moving average. What that means, like I talked about grades, every price is equal. So we don't discriminate. So if you have 20 numbers, you divide it by 20. So each one, and then one drops and the other one adds, each one has an equal, let's say in 20s, like each one has a 5% of the share of that price. So most of the time we will use simple moving averages. If you're a day trader, or if you are like really important, the movement of the, and you're more of a short-term investor, then there's something called exponential or weighted moving average, because what they say is, okay, I don't care what happened 20 days ago, because it's old news. 20 days ago, there were the most recent news about the company or economy was not factored in. The most recent price is like really the more applicable price. So what I'm going to do, I'm going to put more weight or more emphasis on the most recent price. So let's say 5 days ago gets a factor of this, 4 days ago, and then last day gets the biggest factor. So what happens, then not every price or every grade gets the equal treatment. You can hear, like even the final, you can see they say, okay, you had 5 tests or 4 tests, but the final is going to count twice as much as the other. So you really is kind of a weighted. And that's what this comes from, because you want to do something which was most recent. Again, for simplicity, number one, the computers do all these for you, so you don't have to calculate any of these. I just want to, if you're doing a trading strategy, just be familiar with that where it comes. Majority of times, including the institutional investors like mutual funds or hedge funds, we actually, especially in the long term, like when you have a 200-day moving average, really doesn't make much of a difference what happened yesterday compared to 201 days ago. So that's the difference. So that's what they use, simple moving averages. The shorter the time period, on the other hand, could be better to use more of exponential or weighted. So what I did, I thought, just give you a criteria that what different kind of investors use and what kind of moving averages use. What kind of moving averages you should use. So institutionals, most of them, again, mutual funds, hedge fund managers, commercial banks, large investors, they really like the 200-day moving average and the 50-day. So what happens, a lot of times you see the price goes below, let's say 50 days, and then what happens when it goes below 50, all of a sudden, after 2 days, it continues. So moving averages, basically the criteria is when it passes one, it's attracted to the next one. So what the institution use, they need 2 days of confirmation. So what I mean by that is, we call it like either false breakout or not. So let's say a price went below that 50-day moving average 1 day, and if it goes the second day, it stays down, usually it will continue to get to that 200. Or if it's like 20, it goes to 50, 200. So moving averages, they kind of attract the prices. So anyway, the institutions use this. If you're an investor, a lot of, for intermediate term and long term, then you can use 20-day. 30-day used to be very popular in the 70s and 80s. It's not as popular, but you could use 30 days. They use 20 days because the reasoning is 20 or 21 day is because there are 20 trading days a month. So we look at months, we look at the cycles, the earnings come a quarter, so you look at the 90. So we look at, that's the reason maybe we talk about 50 days, because we want to cover all the cycles. The 200, the same thing, 200-day active of trading during the year. So basically that's where the reasoning for 20. And 30-day, it's not used as much, but it's still there. 50-day is a big one. 100 days are important. A lot of people use that, 150. But the main ones are 20, 50, and 200. Now, if you're futures traders, remember the futures have a very short lifetime. So if I'm investing, we talked about, let's say, crude oil, already had the May expiration, June expiration is coming this week. So you have June, then July. So you have a very short history. So a lot of traders, they don't even use 20, we use 18. And then 100 is for the long term, just to give them indication of what was the trend. So this is for the futures traders. If you're a short-term trader, then this 8 plays a big role, which is, again, it's a Fibonacci number. You use exponential moving average. And you use 20 or 21, which is, again, a Fibonacci number, exponential moving average. Then you can decide, do you want to go longer term? It doesn't make a lot of difference, but you could use simple or exponential. The shorter it is, the more important it is to use EMA. So as long as, let's say, you bought something, and as long as the price is staying above your exponential 8 moving average, then you want to stay with it. The minute it turns around and it goes below, then it's a warning, and that's what you have to use your criteria. Maybe move your trailing stop, but that's one of the, again, criteria you could use. And this 34 is, again, is a Fibonacci number traders use. The last but not least, we will talk about Bollinger in the future. We've talked about Keltner bands. When John Bollinger, let's say, did his Bollinger bands, he used a 20-day. Now, we've gone beyond that. That's for the day, but we've done studies, for instance, the band width and which one is better. John Bollinger feels the 20 moving average works the best. The same thing with Keltner. So I thought just a reference point, because as you know, I mean, you have access to all these. After end of our webinar, Sean is kind enough to make these recordings available, so you can review it if you find it informative. So you will have a PDF of this. So that was moving averages, one criteria, and then obviously the price itself. So for the strategy that I'm going to speak about, it takes the criteria of the price and the moving averages. But before I go on, just if you indulge maybe a little of your time and your attention, is just, I'm assuming you don't know anything about prices, anything about the charts. So there's different ways of these charts being drawn. Now that with the computer, it's just so much easier. But there's line charts, but there's 2 really major criteria for, we call it open, high, low, close, bar. That means the price of a holding. It could be, again, currency. It could be, in this case, a lot of you are involved in stocks. So with stocks, what happens when the market is 6:30 in the morning in Pacific time, or 9:30 in New York time, or the same thing in London, when the market opens, you have an opening price. So this is that bar, which is to the left side. The market moves around during the day. It could go down, which that could be your low side, or it could go high, that would be your high side. But at the end of the day, with all the market players, they come and they fight it out, and then all of a sudden it's 1 o'clock in the afternoon or 4 o'clock New York time, the market is closed. This is it. You have to wait till the next morning. So you have an open, you have a close, but you have low and high. So basically all the bar, every one of the bars that you see on the charts, they all have this. The same thing could happen if the open, low, and close. It's the same thing, could be different. So they call it open, high, low, close bar, or OHLC. Now, this is called Western bar, Western chart. And I can show it here. You can see, the market opens. This is it from stock charts, goes up. The market closed it and went down. So you can basically visually see how the markets reacted. So when it's red really actually goes down. It's interesting, the bars I showed you, green is the one which is going down and red is going up. But you get the gist of it. So this is, let's say, SPY. I mentioned to you, we are like really floating between 275 and 295. There's a double top I can see here, but till we break this low, get confirmation, nothing is really happening. So basically this is a bar, which is a Western open, high, low, close bar. There's another bar which is called candlesticks, which came in the 1600s. The rice traders in Japan, they found out when they were in the market and doing the pricing, they came on, it was really easier to see what happened. The same thing again, the price opens, the price closes. And this is called the body, and they call it candle. And why they call it candle? Because you have these little tails. So they looked at this and they said, this is the body of candle. If the closing was higher than opening, then it's green and the body's filled. Then you have the high of the day, they call it shadow or tail or wicks, and you have the shadow at the bottom and the top. It's the same exact idea. You have high, low, open, and close. So this is called long candle, or the opposite is the price is high, low, but it started open in the top of the body and then close at the low end. So this is called, again, as I mentioned, this is more of a came Oriental. So you have Western and Eastern. I really like, 95% of the time I use the candlesticks, because visually, again, I'm pretty visual. I can see the colors and I can see, all right, how long was the tail. It's a little difficult when you look at the Western type of open, high, low bars. And I can see how convinced that the buyers were and how convinced the sellers were. So this is, in a nutshell, it's called candlestick. And this is from Finviz. You can see, right here, we have a long red candle, and then boom, March 23rd happened. We are up, we are going, hit the 20-day moving average. So now you can see at least who's in control. So you combine the volume with the candles, you can see Tuesday and Wednesday, we had sellers in control. Thursday and Friday, the buyers came back. So basically, it's important for you to understand. And then this is from the candle, the stock charts. They don't use the the green or red, they just use basically open and then the red. So here is the strategy I'd like to share with you. It's called moving averages strategy. And basically, there's three criteria I want you to understand. One, actually there's a fourth one, but the moving averages is three criteria. Rather than using all kinds of moving averages, I want to go extreme moving averages. So I want to look at the 20-day moving average, and I want to look at the 200. So 200 is really long term. 20 is obviously short term. So what I want to see is if the price, how far is the price from the 20-day, that moving average? Or 20 bar, I mean, it could be in the minutes or 60 minutes, but I use the day, so it's easier. So if the price is really far from 20-day, or they're up or down, that's criteria number one. Then I want to know how far is these 20 the moving averages and 200, how spread they are. Is there a space, or are they close? Are they far away from each other? And the third thing is I want to know if the 20 moving average is above the 200 and the price is over 20. So this tells me if the price is above 20 and the 20 moving over 200, then we are in an upside momentum, upside trend. So what I like to do is then I see, okay, we are above this. And by doing that, then I can make a decision. Do I want to sell it, the stock, or do I want to buy the stock? The last part is the candlestick, and I want to know, I need confirmation. So basically what it is, the moving averages, they come close, they kiss each other, and they go far, they go apart. So I want to use an example. So here's a 20-day, let's do it 50-day, and then this 200-day. So obviously you can see every time that the price moves away from the 20-day, or in this case even 50-day, but the 20-day, the price cannot stay away from that moving average. It means that there's a magnet, there's discomfort. Either moving average has to move up to catch up with this, or this price has to come and kiss it. So every time there's a big space, we have it here, we have it here, the stock likes to come back and be normalized. So that's criteria number one, right? So when there's a big spread or a big space, the market likes to come back to its moving average. Also, when there's a big difference between the 20 and the 200, when there's a huge gap, let's look at this. This 20-day is way away from 200. Now 200 is trying to catch up. Then that's the second criteria. So when the things are stretched out, they like to come back to norm. When they are either bottom or high. So the idea is this visually, regardless of what the news is, that's why sometimes you hear the news, you say, my God, Tesla had like the worst news, and what happened besides the short covering? How could it go up? Or how could it go down when there was a great news? The reason is the markets need normalcy. They like the digestions. They cannot get away from their natural potential and as far as tendencies. So you can see again, we were away from 20 and we were away from 50, we come and kiss it. We continue doing that. So as long as the market is up, obviously you stay if you like to buy it back. But as a trader, on the other hand, imagine, let's say I see I'm far away, I sell it here, I end up buying here, I sell it here, buying here. So this is, again, you have to study on your own and try to find the best, what works for you. I decided to do it, let's say this is downtrend, and you can see there's a strategy, we call it butterfly. So when you have three moving averages, they're all really close to each other, and all of a sudden there's this separation, and in this case is the downtrend, you know the markets are ready to sell off, and they're going to go down as long as they stay below this 20-day moving average till, you know, again, there's a big gap, and they like to come back and kiss it. So now you can see this closeness here. They came and kissed, but they got rejected. So this is one of the things. So the criteria is that now you get the heads up, knowing that, listen, I was separated, so I have to go back my 20-day. I have a big difference. I have to go back. But, you know, there's a few times that's happened. You don't blindly just buy just because there's a big separation. You need a confirmation. And how is that confirmation? And I use, this is a trailer rental place called, it's a CWH. It's for campers to park their campers. This stock, you can see what you do here. There was a separation. Here there was separation from the 20-day moving average. Here there's a separation, a big time from, again, the 200. There was a separation here, but you don't go blindly purchase that. What you wait for, and this is very important to remember, and that goes to candlesticks, you buy it when the candle color changes, or sell it when the candle color changes from, now the selling is from green to red and buying from red to green. On top of that, so you got one confirmation that it's changed to the green, but this green has to close above the previous, whatever the color was, in this case, red. So if green is higher than red, because you will see there are times that it's there's a separation, but let's say here we still have separation, but green never closed above the red. The color changed. The color changed here. The color changed here, and that actually worked. It finished higher. But the question is, you want to make sure it's the higher than the close. So now you have a confirmation that we have been separated. We are very much separated from 200, and now you can move. And then your 20-day and 50-day become your support. Now, this is as of Friday. You can see now we're getting separated from that 20-day moving average. Although this is crossing, but in the short term, we want confirmation. This is getting away from the 200-day moving average. So you wait till a candle becomes red and it closes below the low of this green candle. So you need two criteria. Besides the moving averages, you want to make sure the colors change, opposite colors, and it closes below. So for instance, this is not a confirmation. Why is that? Because this was green, this is red. The color changed, but it didn't close below the low of that green candle. So that's why you don't sell. In this case, it came back, it went up, so you need that confirmation, although again, we are hitting some resistance here. I don't know if that was, I hope it was helpful. As I mentioned today, what I want to do is, I asked Sean, I want to make it more interactive so we can share some ideas. So I'm gonna, we can talk more, so I want to hear from you. But every week, I don't, if it's helpful, I like to come up with one strategy that I use that it's easier to really implement. Just look at this. The moving averages were so close, and now there is separation, and the stocks just keep staying on up. But every time, this 20-day moving average is like a magnet. So that was my strategy. I thought to give you some ideas as far as the before we open and we can have this discussion. I will go to Finviz, and then maybe we can work on things together. I thought, maybe you could have a watch list for this COVID. Some healthcare stocks that I watch, I have it food related, from Domino's Pizza to Buffalo Wings, and to, I mean, Chipotle and Pizza Hut. I mean, not Pizza Hut, Papa John's, and then James Smuckers, and then consumer, you know. So these are, if you want to have a little watch list to see if this thing continues, this COVID, maybe some ideas to see, to choose to have your own investments. Again, my whole idea, these are all for educational reasons. I'm not here to advise you on investments. I'm just hoping to just give you the tools to be able to kind of refine and get the odds in your favor, the probabilities in your favor, and also do a little soul searching. The last slide that I have is, last week I talked about GBTC, the Bitcoin stocks. There are some related, technology related, or institutional as well as financial related. These are things, if you want to have your own watch list, that might be, hopefully it will be helpful. With that, let me see if, Sean, please let me know if you can see, can you see the stock screener on Finviz, Sean?
Yes, yes.
Okay. So before I open the forum, I just want to share something. So I gave you, like, let's say these stocks, right? This is Finviz. It's open. It is, again, it's free. I mentioned to you, this is my, go ahead and register. It's free again. You can have portfolios. You can set up your own portfolios. But one of the interesting things that this Finviz screener, so it does for you, you can actually choose your own, let's say you got a watch list and you want to see how do they compare. So, you know, we can choose anything. So let's say it's a Home Depot. I just use some Boeing, Shopify, Amazon. I'll just use these four. You can have 20 or 30. So basically by doing this, now what you have a list of, let's say, these stocks. Now immediately you can compare the valuations, their PE ratios. You look at the price to sales, price to book, free cash flow, which we studied, we talked about it, earning per share for next, what was the volume. Then you can just go through all of those. So now you have a comparison, and you can always change this to save it as a portfolio if you want to. Let's say you bought them, now you want to see where you stand, how much money you've made. And now you can see we talked about return on equity. So you say, my goodness, Home Depot has really negative. Now Shopify, which has been fantastic, at 767. As well, I want to watch this to see. On the other hand, I see Boeing has such a great return on equity. Let me see where these are coming from. So you look at the margins, all of a sudden you see, my God, Shopify has a great, you know, gross margins, and Home Depot has a great, but not Boeing, not so much. So the reason I say that, it just makes it a lot easier for you to kind of compare, and then the performance year to date. Now I can see all of a sudden Amazon is up 30. Home Depot is, I mean, remember the markets are all down, right? Shopify is almost 93%, and yet Boeing is down 63%. And this just gives you, you know, for the week what they did. So in one place, now you have, visually you can compare all of these. And now this is for technical. What is their ATR? Remember we talked about maybe putting some support or a target price, and then you can use, here is the chart in one place. Visually, I can see the moving averages. Is it below? Well, Boeing is below their moving. Well, Amazon is on top of it. Home Depot is on top. So these are uptrending, and this is downtrending. And then you can basically get some more information, more detail-oriented. Again, these are four. So I think this is And then you also have more technical analysis. It tells you about the return, what if they had a gap. And anyway, I thought this is interesting. I really like FinViz because it allows you to do so many things. And I have mentioned, I mean, in the morning when you want to look at the currencies are the ones that really dictate all the markets. And I see, okay, right now, Japanese yen is up. I mean, still, you want to wait till Sunday night or Monday morning, for instance, to do this. But then you see, well, New Zealand dollar, which is really risk on, and Aussie dollar, they're down. So the risk on is like Japanese yen. That means I have to be a little more careful and cautious. But these are like overnight, right? So you want to kind of check it out when it's on the beginning of the week, so you have a better evaluation. But there's just so many things with this. I've mentioned about the mapping, and you could look at around the world to see where the markets have been, and then what companies. One more thing I will mention, and then the floor is yours. One of the things I think is important, again, I watch BABA as a proxy. It's a Chinese, but the company, which is really is like works in so many different areas that it can become proxy as far as the health of economy. So it gives me the heads up. So when it goes down, it's usually head. So just a food for thought that companies like can see BABA hit its top in January. That was the COVID was really hitting China. And then it bottomed before actually March 23rd. So I use it just because you're familiar with Alibaba, and then so right now it looks like what the S&P is, but it's interesting. Just again, my whole goal is to give you the tools to give you have the odds in your favor. So once, over the weekend, watch what happened with Alibaba. Where is the resistance? This line is your resistance, and this is your support. This looks like a wedge. It looks like it even could be a triangle. So it's getting really narrow. So I have mentioned to see how wide it was. So the buyers and sellers right now, they are really negotiating to see what is a fair price. So when it breaks either way, then it's probably going to continue because there has been a lot of negotiating and energy, and then upper hand would be in one of those, either sellers or buyers. But anyway, I mean, there's just so many other things. I will, someday maybe we can just look at the screener and how we can, some of the screens that I use, how you can do it. But play with this. It's just like fascinating things that you could do with this. So, Sean, with that in mind, I'm ready to go. It's been an hour and 20 minutes, so I'm going to cut it short about 10 minutes, so we could have the floor, and I'll be happy to answer any questions. So.
Sure. Well, can I ask the first question?
Sure.
Yep. I saw you have the example of the trading for SDS.
Yes, SDS.
Yeah, before you exit your position, I think there a relative long time you are in loss, right?
Good question. So what is SD? Remember, this was a put selling, and that's what I don't encourage anyone to do that yet. So put selling basically is the best time that what we could do with put selling is
oh wow.
Sean, you want to mute one so I can, is that okay, Sean?
Yeah, already
Thank
done.
you. So basically with that.
And can you switch to the trade platform? Because I can see your website, I cannot see the chart.
Okay. So, all right. So you cannot see BABA right now?
Oh, I can see BABA. Yes, I can see.
Yeah, that's right. So I was just going to put SDS here.
Oh, okay.
Yeah.
Thank you.
So with SDS, now the thing about put selling, so you can see it went to the bottom. What you want to do is you want to collect the premium, but you already in your mind, you know, and I mentioned this about Disney, right? We did Disney about a month ago. You could do that. I mean, Boeing is still too early. What I want to do, I want to collect the premium, but also I want to see that the stock that I'm buying, or I'm selling, I wouldn't mind owning it at a certain price. So what I mean by that is, like STS, I was happy, Sean, to own it at 23. So I'm patient with it. So I didn't put any stop loss with the put selling unless it was really getting, like USO was getting to kill me. So I got out of USO because I knew that stories are written all over. So with USO, I gave up a couple of dollars really. But with STS, I am patient. When you do put selling, it doesn't work as when you're buying it. So it's not about owning it. So it's about selling. So I don't mind even if it goes and hits, you know, goes as low as possible. As you said, with Disney, I collected $2.50 on the premium on Disney. But if it hit $50, I would be happy to own Disney. And because I think in the long term, I would have had it gotten a great bargain. Basically, what this is, it might make it easier, Sean. This is like a lease with option to buy. I'm willing to pay, in this case, I collect, but I wouldn't mind owning it at such a great price. So basically, that's the reason. That was a great observation. Yes, it was. You can see it was up and down, right? So when it goes down, obviously it's not good for me. It's like it goes up. That's what I really, because I want the premium to go down. So, but that's it. That's why I don't. I mean, put selling is kind of more of a specific. You really have to be pretty confident in your. You can do spread. That's limited, but with this, I was pretty comfortable, Sean. And then because it was getting close to that 20 cents, I mean, how much more can I milk it out? You know, the $1.20 to 20, I cannot be greedy anymore, and that's why I just closed it. But yeah, I didn't put any limit, no loss limit on that one.
I see. Okay.
Yeah,
Thank you. Yeah.
Good question, though. That is very valid. Okay. Any other questions? Comments? Welcome comments.
Hi, Uncle. I had one question
Shannon, yes.
about you're talking about the reversal in the candle length, where it goes higher you buy. I was just
Right.
wondering what time frame would you recommend using for that?
All right. Well, this is all about, again, when you start, I mean, you want to be more of a, at least not very short-term investor, but the best bet will be, I mean, you can go as far as even weekly, but the daily, that's what you want to use. But you can also do like 60 minutes. So let's say we go to this futures. Again, I want to offer things that you have in your, let's say we did S&P 500. This is daily, right? So, but you want to do 60 minutes. So in a daily, you see there was a color change, and then you come to hourly, and then you wait for confirmation from the hourly if you want. You could even go to 5 minutes. So you start from top, you want the long term. Now, if you're an investor, you start with monthly, you start with weekly, then you go to daily. If you're going to be short term, the shorter term, you want the confirm. So the big brother or big sister, the parents are your big leading. So you want to make sure you go to the trend of the color change of the daily, and then 60 minutes, then 5 minutes. So if you want to be really precise in your pricing, that's what you do. So, but yeah, so I would say most people start with daily. You know, if you want to be someone to hold it for a month, 2 months, 3 months, and then you can use 60 minutes to confirm it. Does it answer your question, Kenneth?
Oh yeah, that's great. Thanks.
You're welcome. All right. Any other questions? Any comments? I mean, was it helpful? Is that something you'd like to see in the future? Again, my whole goal is to have a channel specifically just for the strategies or indicators, so you don't have to wait. You can go on like for 10 minutes. In 10 minutes, you can get all the, and then we can discuss it. But,
Yeah, I have another question.
Yes, Sean.
So by looking at the chart on the screen of the SP500,
Yes.
let's say we look the segment between 6 a.m. and about 11 a.m.
Yes.
How do we decide the trend? Do you say the trend is generally going down, or it's turning up, or it's in ranging? I always got confusion. Yeah.
Yes. So number one, I mean, I would not put any values from, and again, this is East Coast time, so 8 a.m. is really 5. So you want to go, markets open at 9:30, right? So as a trader, your best time is from 6:30 to 7:30. So you want to create a range. And in this case, you can see from 6:30, the trend was up. This is all about overnight, Sean. You see this? This is started 4 p.m., which was after hours. Now, you just look at the volume. The minute the real volume comes, so I will just ignore all of this. So this is your trend. So that's a very valid question. So if you're ready, there's many ways you can see the trend. One of the rules are, if you can write down, or you can, the trend tells you higher low. So if this is the low, let's say it's at 11 o'clock East Coast time, right? So this is the low, this is the high, this is the low, this is the high. So just visually, I'm looking at this. The low here is higher than this low. The high here is higher than this high. The low here is higher than this low. So by just having higher lows and higher highs, what does that mean? That means your trend is up. Your trend doesn't change till you have lower highs and lower lows. As of now, just by looking at this, Sean, we don't see lower lows, because every time we made a lower low, we made the lows, it was higher than the previous low. Here, it was higher than this low. This is higher than this low. So right now, by looking at this, immediately you know, number one, it's uptrend. And this high is higher than this. Now, how do we see it's the reverse? The reverse will be this goes up and then it comes down. So now you have a lower high, right? Are you with me?
Yeah,
so
yes.
Lower high, and then if it breaks this down and goes, then your trend has changed. The same thing you can see, this will be a good, right here. You see we had a higher high, higher low. What happened was here we have lower high, and then we got lower low. And now you know at this area, right around here, your trend has changed. So you got to be very defensive now. And then you can that's one way of understanding what the trend is. Yeah, the second way, go ahead.
Around 2:30 and 3, you have, I think, a little bit lower low, but that's not on the same time scale. So what do you say? Just ignore that?
Oh, yeah. So basically now, good question. So this is not confirmed. So what you want to do is you want to make sure you have higher low. So this is the next high. So basically this is higher than high. This just gives you the warning. Now again, this 5 minutes, right? So it works much better in a daily or long term, but this is higher high than this. And this is really higher low than this. There's a lot of wicks. So this is called neutral, Sean. So you need a confirmation. You say, I'm going to watch it if the trend is changing. But if it goes to higher high, then so you can see the lower, there was no lower low than here. So yeah, it is, I mean, this is more clear here. But then you have the second one, and that's your moving averages, Sean. So if you have a moving average, and let's go to like SPY, and you look at the moving averages. Now, what is the slope of this? The slope of this is a 50-day. It's low, right? It's going down.
Yeah.
The slope of the 20-day is going up, but now what happened is flattening. So now that's why we're getting mixed messages, because the trend of a longer term is down, because we are from left to right. You can see the 200 is flat, so it doesn't help you anything. But the 20-day from this point on was uptrend, so you want to stay long. But now we are flattening, and this is the warning sign I'm giving. Now, if it starts going up, then that's another trend building. But right now, in the intermediate term, the trend is still down. So moving averages, they give you another one. Then you can draw these trend lines, and based on that, you can also say, okay, well, this is up, this is down. Till it breaks above or beyond that, then you don't really know. So that's neutral, even though it's so. But those two, higher high, higher low, and now here we have double top. Did we go higher than this? No. And then last time, remember 2 weeks ago, I showed you the divergence with the stochastics. So this is my warning sign right here. I am ready for anything. So that's why I'm very cautious right now, if I'm gonna, till I get clarity. So we have double top here, so you don't have higher high. You have lower low, right, Sean? You see this?
Yeah.
So you have a lower low. So now, and the flattening, so that's what I said. There's something going on. The trend probably is changing. The other thing, I'm glad you asked, look, we came so close that 50 days. Remember we had the sell-off on Thursday? Do you recall Thursday, the numbers were just awful. We had the 36 million, we had the 3.5 million unemployment, and then, the claims. What happened was the market sold off, I think almost 600 points. They came very close to that 50-day moving average. And then by end of the day, if you recall, they were up like 320 points or something. That's the Dow Jones, but the same thing with S&P. So these moving averages are magnets. So they can repel, they can attract. But right now, next week will be a very interesting week to watch, because we are getting indecision here, or something is going to happen. So, but that's a very good question. All right. Any other question? Anything else that or suggestions? It doesn't have to be a question. So I'm open.
Ramin Hamad here. Can I ask one
yes,
question, please?
Of course, Hamad.
So I wanted to ask you, when you were showing the trade and you looked at that pattern and then you decided to short, but then afterwards you presented something from a put perspective, and I didn't get that why were you doing a put? Because I didn't see an uptrend, or maybe I missed that.
Good question. No, that was exactly because I was betting it's going to go down, Hamad, because I'm betting. My indicators told me there's going to be a sell-off. So the put means putting it down. So that means I make money when it's going down. So that's how I make money. So for instance, if you're here, like Spider, and you think, my God, markets are going to drop, this is where you buy put options. And that's the beauty of options, because you can be both ways. Here, you could have bought call options. Here, you bought put options. And that's the reason I was buying put option, to protect myself or make money if the market went down, which they did. For 2 days. This is where I bought the put. So are you clear with the put? Does that make sense?
Yeah, I am.
Yeah,
maybe it was the same screen. I thought things were looking opposite, but maybe I didn't follow it at that time.
Right. No, I didn't even do anything. There was a selling put. That was maybe I shouldn't have.
Oh yeah, that's what I'm confused
that was
about.
Selling put.
Yeah,
so
I was following
selling,
the first one.
But that was on SDS. SDS does the opposite of SPY. So let's say you don't want to have options, and you say markets are going to go down. So you have inverse ETFs. which rather than you buying the options, they do the dirty work for you. So SDS, there's QID, so there's SDAO, for instance. So all of these, they basically try to protect you, protect your portfolio. If the markets go down, they go up. And the markets go up, they go down big time. So you want to be very careful with that. Since you mentioned that, that's another thing, since I got these charts, so let's slide. Again, you can see this, I mentioned about transportation. The transportation, again, gives me hesitation about this market. So you can see we broke down. We are not in that range. We have broken below that range. So that concerns me. The other thing is the financials. I'm telling you, the financials are the key for the health of S&P. If the financials cannot get their act together, you know, people talking about we're going to go back to all-time high. I highly doubt it. As you could see, the markets did break down below. Remember last week I showed you the range. We broke below this trend line. We went down, but then there was a big comeback, and then again there was some rotation from technology to this. So the financials tried to just break even, but they're not healthy. I'm looking at Wells Fargo. This is the top 5. We have broken below the March 23rd low. I look back, let's go on a monthly. This is where we are right now. We are back to 2012, 2011. Granted that these big banks, because of the yield, you know, they have to, so they make money on the spreads, right? So when the rates go down, it affects their bottom line, but it goes deeper than that. And that's why till I see there's this, the XLF of the worlds are getting healthier. This is, we are back to 2016, 2015. I would be hesitant, and I'm not doom. I mean, it's been great months making money, but it is for long-term health of the economy. You need confirmations, and you need it from the financials. I mean, the technology has done great, but there's only 5 or 6 companies. Look at this. I mean, we are in positive for the NASDAQ, but out of NASDAQ, about, we mentioned 52% of that comes from companies like Google, Apple, Microsoft, Amazon, and I mean, look at Microsoft. This is Microsoft on a monthly basis. You would never know we had, you know, it's like a glitch. So it is, and now we are hitting, you can see, I mean, that's why I want to do your own analysis. Look at Apple, for instance. I mean, they are in their own world, Amazon. So the money is going where there is, so they are taking the indexes up with them. But as I mentioned to you, the companies under 200-day moving average, 26%, only about 74% are below their 200-day moving averages. So that's why I have hesitations. But there are still opportunities. I mean, so one of the ways you can do that is if you go to Screener, see what's going on. This is Saturday. You just want to play a little, you know, as far as the performance. And then let's say you want to go to S&P 500, take a look at it, and then you say, let me see what companies are the best. And then here, it gives you the top companies. I know, Chris, this is one of your companies, NVIDIA. Look at Netflix. This is a biotech company, Regeneron. Look at Newmont Mining. You know, this is mining company. This is gold, Colorax. So this, you can actually have your own, again, it's a story. You see these companies, but the majority of companies, when you look back, I mean, obviously it's a Norwegian. Look at a lot of airlines, a lot of travel, and this is mostly, again, airlines. You can see there's a lot of them are hurting. So, but these are the things you can do on your own. I don't have to, do it, but you can find some gems in the meantime. So there's a lot of energy stocks here. But anyway, okay, it was a long answer for your Hamad. Sorry, just I got carried away. But anyway, any other
Thank you,
questions? Of course, you're welcome.
Oops, no, I meant. Can you hear me?
Sure. Yes, Chris, you're
I
clear.
think you told us when there are red numbers in the different areas and then there are black numbers. And did I remember correctly that the red ones just mean they were out of the range of their competitors? Is that correct?
When we're looking at just analysis on Finviz, is that?
Yes,
Okay.
yes.
Okay. So just
like on this chart.
okay. Let's look at one of your favorites. So now, so what you're mentioning here, right, on the reading,
Yes.
like this, right? So when they're black, they're like absolute value most of the time. So, and earning per share, they don't make any judgments in the sense. So, they don't say, well, income is negative 63 point, but when they compare, there's a percentages or there's a price to sale. So they are like really above the average in their own sector or industry. So we want to see more green. I mean, obviously I like to see there's no debt, and then there's the sales per quarter, which has been the leading, is going up. The gross margins are higher. So yeah, the black doesn't, it's like institutional, like for instance, myself, I don't want like 70% or more institutional owners, because ownership, that's just limits. If it's like 25 to 50%, 25 shows me there's interest. If it's 50, there's really good interest. But that means 50% of institutions still not owning a portion of this. So that's why it's black. So they don't make that judgment. They give you red. In this case, the insider transaction, because it's a pretty big number. That means they're more selling, which doesn't mean anything by itself, because this stock has done so well. Hey, I would take some profits in this. Why not? So by itself doesn't mean anything. But you're right. The black, yeah, it doesn't mean much. It's the red and green I like to look at, to compare to its own peers, basically. And,
So like the earnings per share is a very negative number, and that's just almost like a warning signal.
okay. Yeah, but it's black, right? So no, but it is negative. But you have to remember.
Oh, I'm looking at the red one, earnings per share quarter over quarter.
Okay, earning per share.
Down here with a great big red minus.
Oh, you mean quarter per quarter, right. So it's like a 1 quarter, but yeah, so that's like a cause for thinking, where did this, sales are up very nicely quarter. What happened? Did they have, and maybe there was, I haven't studied their, you can use Yahoo Finance or something. What, did they have a one-time charge up? What happened that affected the earning per share? And in the meantime,
Okay.
look at the earning, for next year. One of the good places to get answers for these, like Zacks.com. Zacks is that they're the ones who give you the, buy, hold, sell. They give you ranking of 1 to 5, and they explain these things, and they tell you what is the analyst expectations and what happened to the earning per share. Yahoo Finance is good too, Google Finance. I mean, all of those you can find it. But that's a good question. Yeah, I will be curious what happened here. But obviously the market, do they care? Not really. Because this is the story, okay, one last thing I'll say from my own point. This market really doesn't care about fundamentals. Nothing. You can come up with all kinds of story. Right now, it's all about where is the liquidity, where is the, again, as far as the Fed goes, and what is the story, the theme? I mean, obviously the cloud and all that, this is the way, and the market feels that it's going to be longer than we anticipate. So, but That's why the cloud companies are doing fantastic in hacking and software and digital Zooming and all that. They're doing very well. So, and online shopping and yeah. Good question though. Thank you, Chris. Appreciate it. All right. Anything else? It's 3:47 our time. And some of you overseas, in UK, it's almost midnight. So thank you so much again.
Right,
Staying
I'm
up
gonna get in before midnight. Okay.
Ah.
Thank you. Thank you very much.
Awesome. Thank you so much, John. Really kind of you. And thank you for your nice comments. I appreciate it. Have a great day and weekend and night. Bye.
Good night.
Good night.
Thank you. Bye-bye.
Of course. Good night. Good night. Yeah, it's midnight in UK. So thank you so much. All right, Sean, if there's no other questions, then I will, we can provide the recording and the PDF, the slides, the next day or so. And I just wish you, first of all, the greatest health and safety and security and wonderful spirituality. It's trying times, but I really appreciate you being with me, and it gives me a lot of positive energy. So,
Thank you so much.
Thank you.
Well, thanks,
Ramin.
Ramin. Have a
Nice
good,
Thank
enjoy
you.
your Las Vegas trip.
thank you. Oh, thank you so much. It's getting overcome. Oh, thank you, Bob.
Enjoy.
Thanks.
Thank you.
Thank
Have
you,
a great
Natasha.
weekend.
You're
Bye.
welcome.
Bye-bye.
Bye-bye.
Good night. Bye, Ida.
Good
Bye.
night.
Thank you, Andikshan. Good night.
Thank you.
Good night,
Bye.
Hamad,
Thank you. Bye-bye.
Henry, and Chris. Good night.
Thank you.
Thank you, Sean.
Yeah,
See you,
thank you.
Kenneth. Bye. Bye. Great. All right.